Matthew Peterson is the managing partner of Peterson Capital Management, which he founded in 2011. He manages a long-term concentrated value-based fund with a very impressive 10-year annual track record that exceeds 19%. He's been a financial professional for 2 decades, is a chartered financial analyst, and has worked with Goldman Sachs, Morgan Stanley, Merrill Lynch, American Express, and Ameriprise Financial. So without further ado, Matthew, over to you.
Thank you so much, Danielle. So testing, 1 million, 2 million, 3 million. Can you hear me? Can I get confirmation on the sound? And how about the video? I still see you, Danielle. I'm not sure if my speaker.
I hear you very well. I see you. I don't see anything in the chat saying that people can't hear you or see you. So I think we're good to go.
Perfect. Okay, welcome. Welcome to the Peterson Capital Management annual meeting. October 1st of this year marks 10 years since the inception of the fund. And it is such a pleasure to have so many esteemed partners involved. We are still at the very beginning, and this compounding machine is on its way to becoming something really remarkable. Our success has been noteworthy, our potential is significant, and I very much look forward to the next 10 years with all of you. Today, I have a few topics and slides to share. I will share those now. And we will briefly hear from 2 interns, as Danielle mentioned, and then we'll move into the Q&A portion of the meeting. The meeting will begin with just a brief discussion on our performance and our track record for the first decade. We're going to discuss several alpha-producing compounders and then explain some deep secrets behind the structured value practices. But first, we'll have a quick word from our attorney. We will be discussing some securities that we own. So we actually have a lot of new faces at this meeting. Perhaps we expect about twice as many to be here from last year. So I would like to reinforce our mission statement. Our mission is to provide a world-class capital allocation vehicle that builds enormous wealth for our long-term partners. And some ask, why are we so focused on the long term? It's because the world is obsessed with daily headlines, speculative products, even intraday meme stocks and price swings. And focusing on the long term gives us a great performance advantage. We can ignore the media noise. We can use short-term price and volatility in our favor and focus on the KPIs that will drive business success for our investments. And so as we conclude this first decade, the wealth creation is very much underway. Our performance is reflected here in the dark blue, and it has been highly satisfactory. 1 million in our fund has grown to 5.7 million during this first decade. We've outperformed the S&P 500 by 25%, and it's nearly triple the value of the hedge fund index average. So since inception, you can see down at the bottom left, we now have annualized gains of 19.4%, a number in which we can be really proud. You can make a few other observations. What other observations can we make? On the left column, we can see that there are 7 years with returns in excess of 20%, many above 30 and even 40%. We also have 3 negative years, 2 of which included declines of nearly 25%. And while short-term price swings are not comfortable and our intention is to make money every year, this is an expected result with a concentrated portfolio like the one we've built. Short-term market price fluctuations happen, and they truly cause us no alarm. It is also notable that we've only had 1 down year in the last 6. And as I will show you, I very much expect that this streak will continue. I will also point out that we're not correlated to the S&P 500. We use it as a benchmark because it's most partners' best alternative to the fund. The success of the S&P 500 index is very unlikely, though, to continue at this pace. The last decade has been a complete anomaly for the index. In fact, a multi-decade average for the S&P 500 is 6.8% after inflation, and that is consistent for over 200 years. So I expect, not for the S&P, but for equities as a whole, it's 6.8% after inflation. And I expect our outperformance to actually grow tremendously over the next decade, not only because our performance will be good, but because the S&P's ascent will almost certainly slow. So, it's been a year since the depths of the crisis when I was encouraging partners in writing to add capital. Many new partners joined. I'm very pleased about that. Many others made contributions. And although the significance of this becomes disguised over the calendar years, it's still really worth acknowledging. We are up over 100% net of all fees and expenses over the last 12 months. We are also up 30% year to date, and it's only August. Now, today I'm going to share some secrets to our success. And as I mentioned in our last quarter letter, we're applying our structured value equity purchase method to some strategic opportunities where large gains are currently available. And we'll get to those details shortly, but to understand what I'm going to explain, we have to revisit the building blocks on our investment process. So long-term partners may recall these specific steps of our process. And for those wanting more detail, I've included extensive information in our annual reports, on our website, and in presentations on our YouTube channel. We follow a 4-step process. We start with a 13F analysis. Second, we perform fundamental analysis on the firms. Third, we analyze the possibilities to apply our structured value purchase method. And finally, fourth, we apply our portfolio construction philosophy, which includes considerations like the Kelly criterion, because we're really looking to optimize our portfolio position sizing and capital allocation. We have high levels of concentration because we have high levels of conviction. And this is an optimized level of diversification. So to elaborate on each of these alpha producing steps, I'm going to show you, here is an example of our internal 13F analysis. So each quarter we track about 100 successful long-term value funds, and any firm with more than 100 million assets reports their holdings to the SEC at the quarter end. So value funds in particular often hold positions for years and decades and have concentrated portfolios. So we can easily analyze what admirable investors are buying and selling. And I'll remind you that screening for cheap companies based on ratios or other fundamentals is not an efficient or effective method, because it delivers all sorts of companies that appear cheap but have hidden problems. So it also ignores many of the great companies that have unique accounting attributes. So in stats, we would say that the output of a screen would create and contain many false positives. And our approach is really quite simple and very beneficial. It allows us to avoid many errors, and it narrows down 10,000 potential opportunities to a few hundred that are much more likely to have promising characteristics and deliver promising results. And by the way, it's also a lot more interesting because my time is spent studying great businesses rather than mediocre ones. So from this starting point, we can now begin our fundamental analysis. And fundamental analysis, of course, begins with understanding the financial statements and all public reporting. But further, it includes our co-priority framework. We are looking for superior business models, we're looking for superior management teams, and we're looking for extraordinary value. And many investment firms stop at the extraordinary value bucket. And that's the Benjamin Graham approach to buying $1 for 50 cents. And you can use this approach to buy cheap businesses, but this is also what leads people into value traps. So if the business is not growing, or if it's in some secular decline, the price might never re-rate, even though it looks cheap. And the business value might even decline to the market price. So we're not only looking for dollars selling for 50 cents, we're looking for dollar bills being produced by great businesses with great management teams that are far more likely to increase in value over time. And when you have an extraordinary business and management team, you can come across these Fisher compounders. And these can grow and compound asymmetrically for decades. So this is enormously underappreciated even by some who consider themselves value investors, but it allows portfolio managers to sidestep frictional costs like trading expenses and the enormous cost of taxes. It also reduces the number of decisions that are made and the possibility of making an error. So the long-term profit outcome of holding a compounder is vastly superior to buying and selling a new cheap business each year. And that's why our turnover is so low. But in step 3, we also have another advantage. Upon locating a firm we wish to own, we apply our structured value approach to purchasing equity. This is very unique and very advantageous. Most investors buy stock either through a market order or a limit order, but there is a better way that works extraordinarily well during times of uncertainty and volatility, which I expect to persist. So let's look at this example. This is a stock that costs $100 on the New York Stock Exchange. If we want to purchase stock for $100, we do not do it like a retail investor would through the New York Stock Exchange. Instead, we go to the Chicago Board of Exchange and we write a cash secured put option as a tool to own the equity. Now, many of you will recall that buying a call allows you to buy stock at a predetermined price in the future, and buying a put allows you to sell stock at a predetermined price in the future. If we create and sell a put to a counterpart, who is then the buyer, it allows them to sell us their stock. And we want their stock. And they pay us for the contract. So instead of buying for 100, we might request 25 for our commitment to buy their shares for 100 over the next year. And then there's a buy-only outcome as the position closes. Either shares decline below 100 and we get put the shares for a net cost of 75, which is the 100 that we pay less the 25 that was paid for us. So we now own the stock for a net cost of 75. Or alternatively, the stock doesn't go below 100 and we don't get the shares. And that means we earn and keep the $25 premium on our $75 in collateral, and we earn 33% in a year. So we'll be coming back to these examples, and there simply aren't that many opportunities like this in the world, and that demands a strict level of discipline, which is why we are so pleased with the small basket of compounders that we own. These firms make up the majority of our portfolio, and each are extraordinary businesses with exceptional management teams, and we're buying them at very inexpensive prices, and they'll continue compounding. We have an infinite time horizon. We have no intention of selling these holdings, and some of these businesses here are actually quite small. The Daily Journal, for example, is under a 500 million market cap, and it has a 300 million equity portfolio of its own. So the business is only 200 million, and it can become large. This has allowed our modest size fund to purchase a full 0.5% of all the shares outstanding. We now own 0.5% of the entire Daily Journal business. Dondo Holdings, which is run by famed value investor Manish Prabrai, has just a $30 million book value, and we own over 2% of that business. We aren't invested in it, we own it. And Seritage, as I'll show you, is worth about $2 billion, and is selling today for just $650 million. So let's quickly dive into a couple of these holdings. First, we'll keep with tradition and show you how Berkshire is developing. Berkshire, of course, has an impeccable business model and exemplary management teams throughout the entire organization. And in 2019, I disclosed our expected market cap in 2030 of 1.7 trillion. And some very intelligent people pushed back early on, questioning, how can I expect Berkshire to become the largest company in the world, et cetera, et cetera? Well, it didn't actually have to be the largest company in the world. We now see many companies have surpassed the $1 trillion mark. Apple alone is already worth 2.5 trillion today. Berkshire shares are up about 40% in the last year, yet our models show it still has 35% upside to the true value today. So it is essential that you understand also that Warren Buffett is currently buying back tens of billions of their stock each year because of these share buybacks, the stock can actually perform better than market cap growth because there will be fewer shares owning the business in 2030. So this is a vast oversimplification, but basically in 2021 value column, you can see that as of last week, they have 144 billion in cash, they have 308 billion in equity, and the value of their operating businesses is 450 billion. So this suggests a 900 billion value today, which is a 35% upside from today's prices, and it is growing. And that is why Buffett is spending tens of billions each year buying back his own company stock. But of course, that's not all. We're going to keep coming back to these examples. We don't pay NYSE prices for our shares. We don't buy like a retail investor would buy, and we are getting paid premiums all along the way as we hold these shares when shares dip in the market. So again, similar to the previous example with the $100 stock, we use structured products as a tool to own the equity. And just last year, this is a real example, we were paid $18 to purchase shares for $165 over a 6-month period. This was an extraordinary price, and we picked up a 25% annualized IRR on our collateral during this opportunity without even owning the stock. We just committed to buy more if it went down. And so this is just totally remarkable that we're able to pick up this level of IRR on a company that would be as undervalued and as strong as Berkshire Hathaway. But now I'm going to briefly illustrate the power of structured value with a less known firm, Seritage Growth Properties. So this is a highly contrarian position that we own because it's a small special situation that is really misunderstood. This is a REIT that doesn't pay a dividend because they're reinvesting their revenues at high IRRs to redevelop the property that they own. So Seritage is the real estate investment trust that includes 154 ex-Sears mall anchors and standalone stores that were spun off prior to the Sears bankruptcy. And these legacy positions are in ideal locations. It's Santa Monica, California, Redmond, Washington, downtown Honolulu. There's 3 of them in Miami, Florida. And having completed a property by property analysis of all 154, I'm very well aware of the value, and there's a really logical way to think about this business. These properties are being repurposed into mixed use space, and they're in 3 distinct phases of redevelopment. First, in the first bucket, we have properties that are developed and they have paying tenants, and these are often triple net leases. So they have 91 million in NOI in this category, and using a conservative 7% cap rate versus the industry standard, which is sub 5%, these properties are conservatively worth 1.3 billion. Next, in bucket 2, projects underway. This means properties that are being developed right now. And some have a signed tenant waiting to move in, and those leases are going to pay 65 million in NOI over the next 12 months. And the other properties being redeveloped are available to be rented upon completion. And these leases will conservatively bring in about $50 million in NOI as they hit the market over the next 36 months. The total conservative value, again with a 7% cap rate, is here, 165. Finally, the third bucket is there remains about 15 million square feet of property that is going to be sold or potentially used in future development projects. If they are sold for a conservative $70 per square foot, these properties have a value of $1 billion. So combine that down at the bottom with the cash, the debt, the CapEx, including the development costs, including their joint venture efforts, they have $2 billion in enterprise value today. With $2 billion in enterprise value, if we fully dilute the shares for some special units that are owned by Eddie Lampert, the price per share will be over $35 when the projects from the second bucket are completed by 2025. And that price might be much higher. So the shares today are priced around 15. That implies a 23% annual return on the business through 2025, a conservative, by the way, 23%, in a zero interest rate environment. But again, as I mentioned, that highly satisfactory return is not all. We now overlay the valued approach, our structured value approach, to share purchases. When we agreed to buy shares for $15 through January 2023 through the Chicago Board of Exchange, we sell a cash secured put for a price or premium of $4.50. So what are the possible outcomes after selling this contract? First, if the shares decline below our $15, our counterpart will put the shares to us for a net cost of 15 minus the $4.50, $10.50. This is 30% below the cost in the New York Stock Exchange today. Further, when shares reach the expected $35 stock price, we earn over 3x our purchase price in 4 years. That becomes a staggering 35% annualized compound return instead of the previous large gain of 23% annualized return. So what happens then if shares do not decline below 15? If they don't decline below 15, we simply keep the premium. We earn $4.50 on our $10.50 in collateral over 17 months. That gives us an astonishing 42% gain over 17 months without even owning the shares. So finally, because everyone should be asking about risk, the huge embedded margin of safety is notable. First, because this firm is backed with hard real estate assets worth more than the market price today. And second, through our purchase method. If we are wrong about the valuation, and frankly, we're not wrong about the valuation, but if we were wrong about the valuation, we're only paying $10.50 net for the same stock that costs $15 to a retail investor. The stock can decline a full 30% and we still make money. And that decline is really unlikely, but should it happen, the portfolio will be just fine. So you don't need to follow all the math, but what you can recognize is that our structured value strategy involves using puts as a tool to purchase stock for below market prices. And you've all been very patient. I'm gonna now show you exactly how we're able to apply this structured value to a special situation during this unique period of uncertainty and volatility that's going on through the pandemic. Internally, we refer to this position with the admittedly awkward name structured dividend capture, but that is exactly what it involves. We consider the basket of stocks that are in this space as one portfolio position. So through extensive research, we've identified some secure businesses that are paying high dividends and also have abnormally high option premiums, meaning we are paid a lot to purchase the stock. And if we're paid a lot to purchase the stock and then paid a high dividend and then paid a lot to sell our shares via a covered call, which is the inverse of a cash secured put, we can make a significant percentage-based return over a relatively short period of time. So again, we treat the basket of opportunities in this space as one position, one holding in the portfolio. And as you'll see, we're rotating capital through these holdings. So this is going to get a bit complex. So I'm just going to jump right into it with an example. Just remember, we are basically finding solid businesses with exceptionally large dividend payments that we can capture using our structured dividend methods. So allow me to explain via this example. This example shows what happens with Kinder Morgan, one of the largest energy infrastructure companies in North America. KMI is currently paying over 6% annual dividend, and that's paid quarterly. And you can see this dividend in our diagram here above the ex-dividend date as plus 1.5%. So this blue line here is a timeline moving from left to right. So in this case study, by selling a put that expires prior to the ex-dividend date, we can capture a 75-cent premium and then buy the stock for $17. We then receive a 27-cent dividend and immediately use a covered call with a 10-cent premium to exit the next week. We thus earn 3 incoming cash payments worth $1.12 over a very short time horizon. We earn 4% from the put, we earn 1.5% from the dividend, and we earn another 0.5% from the covered call, and we're back to cash. Okay, this provides us with a 6% gain in just 14 days. The astonishing annualized return of this situation is over 350% in a year. The problem, of course, is we can only do this 4 times a year. There's only 4 times that a dividend's paid. Fortunately, there are some other companies that offer this sort of yield. So let's take a look at AT&T. We see here that AT&T is paying a 7% dividend quarterly. We show that it's here actually as it's rounded up to a plus 2% dividend each quarter on the ex-dividend date. The ex-dividend date is also different than that of KMI. So if we sell a put here that expires on July 2nd and hold the shares during July 9th, we can exit with a call on July 16th and capture a 3.6%. We capture 3.6% during this 2-week period. Again, this annualized return is astonishing. It's 150% annually. But further, this is a real example, and it also illustrates the outcome where the stock price fell nearly 7% during our holding period. So we still earned 3.6% over 2 weeks when the stock declined 7%. So how good can this get? Well, here is a capital flow diagram that starts with the allocation to KMI and concludes with the allocation to AT&T. And what you see here is that by picking up each of these dividends using the structured value purchase and sales method, we pick up 21 payments on these 7 securities, and this earns 41% in a single quarter. It's incredible. In fact, Buffett has remarked in the past that if he were only managing $1 million, he could guarantee 50% annual returns. And it's opportunities like this that make it possible. Now, not every position is going to work perfectly, but the gains are so high in this space that we can literally afford to miss a couple that don't hit the strike price of our contracts perfectly. And, you know, one might wonder, how could this anomaly exist? First of all, this won't last forever. I think there are 2 conditions that are allowing this to persist longer than expected. First, this is sufficiently sophisticated. It's a sufficiently sophisticated strategy that your typical retail investor or market participant is going to have very little success in chance of executing this successfully. But second, and more importantly, the volume in these products is too low to allow larger players to get involved. So anyone filing a 13F with the SEC would struggle to put meaningful capital through this approach. So smart money will just leave this niche space open for us, and we are very capable of making meaningful returns here. So in this situation, having a modest fund size with 15 or even 20 million under management, it becomes a huge advantage. And finally, it's worth commenting on the enormous amount of analysis that was required to reach the conclusions on this diagram. And each quarter, this capital flow diagram will look different. So don't go just putting this in place blindly. Prior to putting this in place, months of analysis were required. Identifying the initial positions of value was extraordinarily time intensive. And ultimately, I realized we needed a better solution. In fact, we needed an automated solution. So this is the flow diagram of the in-house automated solution we built to aid our analysis. So using Python, we reduced the time for analysis from months each quarter to just a few hours. The software we built gathers data from 3 different subscriber databases and creates a 13F superset. It breaks down the KPIs for us based on financial statement fundamentals, and then it identifies the ideal capital flows based on IRR parameters in excess of 100% annually. So we truly can't be sure how many more quarters we're going to be able to operate this efficiently. Certainly, the increase in uncertainty around the pandemic has delivered many more opportunities than we previously thought possible, and we have not experienced any slowdown yet. We will end this position whenever it becomes unfavorable, but in the current environment and likely into 2022 and perhaps into 2023, we will be applying this special situation to our portfolio, and it is giving us a major tailwind. So with this, we are reaching the end of my prepared slides. Before moving on, I would like to acknowledge all of our exceptional service providers from Eulish & Associates, who handle all of the administrative duties, including tracking the new investor capital commitments, to Spicer, who provides our annual audit for the annual reports, and Eric Brill, who's responsible for legal. We are truly fortunate to have these providers, and it's worth recognizing as well that each of these providers has been with us since the inception of the fund 10 years ago.